Mike Muller, head of Vitol in Asia, to give us his thoughts and reflections now a week or so after OPEC Plus finally got to a decision. And then also maybe in your thoughts, Mike, the interview that the Saudi energy minister gave on Monday after the decision, your thoughts on all of those events and what direction the market's moving as a result.
I think you're on mute.
Mike is on mute,
yes.
is he?
Hi, thanks for that, Sean. Yes, I don't think too many of us would have predicted many weeks back that the market would cycle as low as $74 Brent. And now we've bounced, as you said, in Asian morning trading to nearly $76. And it all comes down to one thing, which is concerns over demand. I think it's relatively clear to see what we can expect in terms of production on the supply side, including OPEC Plus. So we have the 9 million barrel a day Saudi number set in everyone's supply and demand balances. But on the demand side, I mean, just today there was a Moody's downgrade on China credit outlook to negative, and that just adds further concern to an already concerned picture around demand growth. And there is a view that the OPEC Plus resolve to take barrels off the market is just about doing enough to meet this revised downward demand forecast. And if there's any further bearish news in terms of demand indicators and nowcasting from economies like China, then we could indeed still see inventories build in the winter months. And that, of course, weighs heavily on people. Then the next thing to look at, of course, is open interest of spec traders. Is this a market which is still risk off? Are people about to be re-entering the market to place bets on going long oil? Right now, open interest is across all major energy commodities is at a low. In relative terms, gas is looking a lot healthier than oil because of various concerns about weather outlook and cold snaps here and there. But the picture on oil, there seems to be a risk-off consensus.
Demand, obviously, he's talking from China, but the supply, this big story of the last month, the OPEC Plus meeting, or the discussions they had, they were protracted. They were struggling to get to a decision, and they finally got to one. And a lot of the talk in the lead up to the announcement, obviously the virtual meeting that was going on, the jawboning behind the scenes, was all about the African countries not being very happy with the this realignment of the quotas, when in reality, listening to the Saudi energy minister on Monday, it seemed to be all about Russia and the credibility of this supply agreement being under question. And that's what the downward draft is. If you took all of the cuts that OPEC Plus are currently sitting on, surely if you believed it, with all those cuts, the price should be higher. What do you think of that supply question and the credibility of the OPEC Plus group at this point?
Yes, there's so much speculation on this. So I think we need to look at the hard facts one by one. First, on the Africa side, I think it's fair to say that they haven't been able to produce anywhere close to their previous quotas, and therefore it was realistic and pragmatic to bring those quotas down. It just so happens now that Nigeria and Angola have been producing a bit more than some had expected because demand forecasters had gotten ahead of themselves, and now there's been a little bit of surprise to the upside on the production front, and that has caught a few people out. But these are, in the scheme of things, relatively small numbers. Then you have fellow core OPEC and GCC countries. I mean, if you look at Oman, for example, they're always amongst the first to walk the talk, if you like, and almost instantly they announced through operational channels that the tolerances would be exercised on all cargoes loading in January, and therefore their cut would effectively be introduced. And we now expect the same to be the case for various other countries. We have to remember the impact of this because Omani crude and Emirati crude is priced off M-2. So January cargoes have already fully priced. Yes, and because the market is now lower than it was in the month of November, it adds an interesting little dimension to things because these producers are giving you less oil at a price that is out of the money anyway. So that kind of fits, and therefore I think those cuts will be generally accepted. In some instances, they don't manifest themselves as 5% cuts. They manifest themselves as cargoes being deferred. So a couple of cargoes at the end of January will slip into February, and in general, the refining system can make do with that as well.
Mike, the market in looking forward, obviously it is all about the new year. We're going into the sort of the off season or distracted holiday season. The market is in contango for the first time in a while, looking out 6 months. What is that impact going to have on the market? Is that to be short-lived in your opinion? What's contango mean for this market?
It's not unusual given the set of supply demand circumstances that have taken the market down into the mid-70s. Absolutely. I think the contango is not one of those contangos where you end up storing oil for the following month. We're not at that sort of level yet, and let's not forget the high cost of capital, working capital. People have to factor that into their thinking also. But yes, it is
much more expensive now than it was when the last time we had contango.
You got to pay 6% for your money, right? Or whatever your cost of borrowing is. So that means you need much deeper contango before you can start talking about a carry and carrying January oil into February and so forth. I think there's a risk in this market that people are getting into a little bit of a bear frenzy. I mean, the March 2020 standoff, which was rapidly followed by the realization that COVID had to be addressed, and OPEC Plus did something unprecedented. And the cohesion of OPEC Plus since March, April 2020, which has been really resilient and formidable. Of course, people are looking for a scenario where they're saying there might be a collapse in the alignment of objectives. I don't think we have a set of circumstances here which we should read that much into. I think there's a great danger that people say, oh my gosh, there's about to be a March 2020 situation repeated all over again. And I think various ministers that are involved in OPEC Plus delegations are astute enough to know that cohesion is now paramount. And what happens behind the scenes, we may never know. But I think we should look forward to statements of mutual support and cohesion, because it's in none of their interest to have the outcome that Christoph hinted at before.
On that point, Mike, even if we get, and it does, the soundings are that the OPEC Plus, or at least those members within it, I think it's 8 members that are really consolidating their positions in these cuts going into the new year, and this Saudi minister feels very confident that they will all deliver as promised, and have done so in the past, and take him at his view, and he tends to not be wrong too often. But Mike, looking at the things outside their control that we saw this year, that Christoph has referenced on the supply side, US production up 800,000+ barrels a day, Iran exports up to 1 million+ barrels a day, Guyana and others adding some barrels here and there. Going into a new year, can we see that trend continue, or is that a plateau in your opinion? The non-OPEC Plus countries' supply continuing to increase as they did in 2023?
I think you've touched on an important observation that sets the tone here. We have spent the last decade having supply out from one or more of several countries that have either been sanctioned or troubled. And let's add Venezuela to the list of yours as well. After General License 44, the market is busily trying to place Venezuelan oil, which is incremental to what was coming out before. You've commented on Iran. So yes, we have this unique situation where we have no disrupted supply from any of these countries that are sometimes challenged with their exports. And then you've got Nigeria rebounding where there had been trouble. There seems to be no issue around Libya. And the only tranche of oil, I guess, that is yet to be released to market by finding an evacuation route is Kurdish oil. But yes, everything is there in terms of taps being open, and in some cases, lack of intervention in flows of sanctioned barrels. So that has fed the picture for sure. Again, I can't emphasize enough and repeat Christoph's point. Inflationary pressures mean that in real terms, today's oil price is at the low end of the range, and it's getting quite close to the levels at which large investors in the upstream do their screening for projects. So those companies don't tend to be companies that hedge and try and sell the forward curve, but the forward curve is in the low 70s or whatever, is not far off the screening values against which major projects are screened. And I saw a report recently from one of the large Wall Street banks suggesting that the marginal cost of shale production in the US is now mid-60s. So that is quite close for comfort. The price never gets fully there because then people don't deploy rigs anymore. I'm not saying we're going to see cuts in upstream spend, but we're not far from the levels which discourage sanctioning of new projects, new FIDs. So I think the appetite to invest will slow. Yeah. Sorry, Sean. Peak demand is a huge debate, of course, because the OPEC view, as presented at your dinner in Fujairah a couple of months ago, is that we're seeing demand heading to 116 million barrels a day. And of course, it's not particularly fashionable for any reputable company to go out there saying all demand's going to keep going and we're investing in it. But I think deep down, most people acknowledge that there is growth to come and investment is required in the upstream. Still,
one of the big Chinese oil companies said this week that China peak oil demand was 2030. I think they identified it. I was at a talk during the week during the COP sideline events, and S&P Global Commodity Insights held a scenarios outlook where they also called peak oil demand in 2030. So the IEA is no longer the only one that seems to be echoing that. A more immediate term, Mike, I wanted to get your views on, with these price levels, again, it brings the oil price cap, the Russian $60 oil price cap back into the money, so to speak, of legal engagement, given it's below $60. Does that move the needle on anything, do you think, at this particular time when this more robust sanction busting police are out and around?
Well, I commented before that the policing is perhaps not as much as some people would have expected, which has enabled the flows from various sanctioned sources. But yes, as we move closer to that $60 level, that may bring more participants in. I think it's been a pretty transparent observation that the discounts for Russian oil have diminished. There's actually been competition created by the various channels to market that Russia has engaged to market their crude to largely China and India, but also some other economies, and on products it's even more prevalent. So I think there'll be further compression in those discounts, and we definitely are not below price cap yet. So I don't think there's any change to the constellation of parties that are able to handle Russian oil and comply with the restrictions that need to be observed.
Mike, just your closing thoughts on the month ahead. I mean, much mightn't change with terms of the sort of basic demand picture, basic supply picture. But what does change is low volumes of trading, the general distraction away from the market. And so, what impact could that likely have in a market with the current profile?
I think this risk-off mindset I highlighted tallies with year-end. It's actually school holiday month in Singapore, so I think there's a lot less appetite to put on big positions in the market right now. I think we might get ourselves into a situation where we get more bearish than we should be. Even on China, I mentioned before the Moody's downgrade, but if you look at what's actually happening, central government propping up provincial governments and creating an internal stimulus should be good for demand. And therefore, I think there's a danger that we start getting ourselves too bearish China, too bearish on the demand side of things also. And I've said it several times in this call as well already, but I think OPEC Plus will find the right balance and will communicate externally, whatever might be happening internally, in a consistent manner. And I'm looking for those signals over the coming weeks in terms of, we've already had the Saudi OSPs at robust levels. Same, no change in stance there whatsoever. And I expect there to be follow through in terms of cuts being implemented from other OPEC Plus members to hold the line.